Welcome back to the Deep Dive. Today, we're looking at a name probably on a lot of your radars, the Trade Desk.
Okay.
We're talking roughly 60% down from its high last year, right? And there was that, 30% drop just back in February?
That's right. A very sharp decline. And, when you see numbers like that, it naturally makes you wonder what's going on under the hood.
Absolutely. Is it a temporary blip? Is it something more fundamental? That's what we want to unpack today. So for investors looking at this, trying to figure out if this is an opportunity or, a warning sign.
Precisely. You can't just look at the stock chart. You need to understand the actual business, the challenges, the potential.
Okay, so let's start right there. For anyone maybe less familiar with the whole ad tech space, what exactly is the Trade Desk? What's their role?
Right. So think about big brands, like a Coca-Cola or the massive advertising agencies like Omnicom. They need to place ads online, right?
Websites, streaming TV, apps.
Exactly. All over the place. The Trade Desk provides the software platform. It's called a demand-side platform, or DSP, that helps these advertisers buy that ad space efficiently.
So they're on the buy side, helping the company spending the money.
Correct. They're not the ones selling the ad space. That's the sell side, the publishers, the website owners. TTD focuses purely on the advertiser, the demand side.
Got it. Okay, but it's a crowded market, isn't it?
Yeah.
Lots of ad tech companies out there. What makes the Trade Desk stand out? What's their sort of special sauce?
Good question. Several things, really. First off, transparency is a big one for them. They make a point of showing clients exactly where their money is going, the bids, the costs, how data is used.
Which isn't always the case with the walled gardens, like Google or Amazon.
Exactly. Those platforms can be more like black boxes sometimes. TTD aims for clarity. Also, clients keep control and ownership of their own data, which is huge for advertisers wanting to build their own insights.
Okay, transparency, data ownership.
Yeah.
What else?
Well, a key point is they don't own the ad inventory themselves. They don't own websites or streaming services where the ads run.
So no conflict of interest. They aren't pushing their own stuff.
Right. Their job is just to get the best results for the advertiser, period. They also plug into, a massive network of data partners, identity solutions, inventory sources. They call it an open ecosystem.
More choice for the advertiser then.
Yeah, loads of options. And then there's the tech itself. They invest heavily in AI. You might hear about Koa or the newer Kokai platform for really sophisticated targeting, custom algorithms.
And they work across all channels,
Right.
not just web banners.
Oh, yeah. Display, video, definitely connected TV. That's your smart TV streaming audio like podcasts, even digital out of home. It's billboards and retail media, too. Plus, they're big on privacy solutions like Unified ID 2.0, which is crucial now.
This seems like a solid pitch. And didn't they have some strong numbers despite the recent stock trouble?
They did. They processed a record $12 billion in ad spend on their platform in 2024. And their customer retention has been over 95% for 11 years running. So clients tend to stick around.
Okay, strong fundamentals, client trust.
Yeah.
But that brings us back to the stock price drop, and the name Kokai keeps coming up. What is Kokai?
Right, Kokai, launched in June last year. The company called it their largest and most important platform overhaul ever. It's their new big AI-driven platform.
The next generation, basically.
That's the idea. Big advancements in AI, measurement, how partners plug in, the user interface, really meant to be the future of their offering.
Largest and most important sounds ambitious. So what went wrong? Or maybe what's been challenging?
Well, the rollout, the adoption by clients, it's been slower than they hoped. Significantly slower, it seems.
And that hit their numbers.
Yeah, that was a major reason they missed the Q4 2024 revenue forecast, which was a big deal. First miss in, 33 quarters? That definitely spooked investors.
Understandable. Were there specific problems with Kokai itself?
There were some initial bumps, it didn't support certain types of guaranteed ad deals at first, so users had to kind of flip between Kokai and the older system, Solomar. Not ideal.
Bit clunky.
Bit clunky, yeah. And there's been some chatter, some skepticism in the industry about whether it was truly delivering on the promises right out of the gate. That disconnect between the hype and maybe the initial reality even led to some legal questions being raised.
Oof. Okay. But what's Kokai supposed to do? Assuming they iron out the kinks, what are the benefits for an advertiser?
So the promise of Kokai is pretty significant. It uses AI to make media buying much smarter, processing millions of options a second, predicting which ad slots will clear at what price, scoring how valuable each impression might be.
More automation, better decisions.
That's the goal. And it's very focused on audiences using the advertiser's own data, plus the Seeds feature to find lookalike customers. Better measurement tools, too, like ways to track retail sales impact or TV ad quality.
And easier to use, supposedly.
Yeah, streamlined partner integrations, a new interface called the programmatic table. It's designed to handle all channels, especially CTV, and built with privacy, using things like UID 2.0 baked in.
So the potential is there, but execution.
Execution has been the challenge. They want everyone on Kokai by the end of 2025. They even did a big internal reorganization last December to try and speed things up, focusing on CTV and retail media.
And wasn't there a management change, too?
Yeah, the VP of product left not long after some of that critical commentary about Kokai surfaced. So clearly, getting Kokai right is priority number one.
Okay, a huge internal focus. Now, let's shift gears slightly. There was that big antitrust ruling against Google recently. How does that potentially affect the trade desk?
Ah, yes, the Google ruling. Huge news in the ad tech world. The court basically found Google illegally monopolized parts of the market, specifically the tools publishers use to sell ads and the exchanges where those ads are traded.
Right, so Google controls too much of the plumbing, essentially.
That was the finding. And for a company like the Trade Desk, this could potentially be a very good thing.
How so?
Well, if Google is forced to sell off some of those ad tech assets, it could break open the market a bit, make it more competitive.
Meaning TTD might get better access to ad inventory, a more level playing field.
Exactly. It could mean easier access to publisher inventory, fairer pricing in the auctions, maybe lower costs for advertisers on TTD's platform, and perhaps better payouts for publishers, too.
Sounds like a win-win if you're not Google.
Potentially. It could spur innovation, too, if Google can't, squash competitors as easily. And it aligns with TTD's whole narrative about wanting an open, fair market.
Okay, but are there reasons to temper expectations? Could the impact be less dramatic or take a long time?
Definitely. First, these things take ages. Appeals, figuring out remedies. Google's dominance won't vanish overnight.
Right, legal battles drag on.
And the ruling was specifically about the publisher tools and exchanges, not directly about the advertiser side, which is where TTD lives day to day, so the immediate operational impact might be limited.
That's a key distinction.
Yeah. Plus, it's hard to predict exactly how the market will shape out even if Google divests things. And TTD has growth drivers like CTV, where Google isn't quite as dominant anyway. So it's a positive potential tailwind, but uncertain in the short term.
Okay, so something to watch, but maybe not a magic bullet for TTD right now. Got it. Let's talk competition. AppLovin keeps getting mentioned. How do they stack up?
Yeah, AppLovin. They've had a meteoric rise, and their market cap actually overtook TTD's recently.
Really? Wow. But they started differently, didn't they?
Totally different routes. AppLovin came primarily from the mobile gaming world, helping app developers monetize more on the sell side, building an exchange. TTD, as we said, was always buy-side, focused on brands and agencies.
But now they're bumping into each other more.
Increasingly so. AppLovin is pushing hard into areas like e-commerce advertising and, crucially, connected TV, TTD's home turf. So, yeah, direct competition is heating up.
And AppLovin's been doing well.
Very well. Strong results last year, apparently fueled by their own AI engine, AXON 2.0, big jumps in revenue and profit.
So how do they compare on valuation for an investor thinking about this?
Well, it's interesting. Because of TTD's stock drop and AppLovin's rise, if you look at forward-looking metrics like price to sales or price to earnings ratios, TTD currently looks significantly cheaper than AppLovin.
It's potentially a better value proposition for TTD right now, despite the Kokai issues.
That's one way to look at it, yeah. The market is valuing AppLovin's recent growth much higher, but TTD might look more attractive on a relative basis after its pullback.
Okay, so even with Kokai struggles and AppLovin rising, where are TTD's big growth opportunities moving forward?
Connected TV is still massive for them. It's like almost half their business already, and that whole market is still growing fast as ad dollars shift from traditional TV. They have partnerships with most major streaming players.
So riding that streaming wave.
Definitely. Retail media is another big focus, helping retailers build their own ad businesses on their websites and apps. And of course, getting Kokai fully functional and delivering on its AI promise is fundamental to future growth.
Makes sense. What about external risks?
Yeah.
Things outside their control. Economy. Policy.
Always factors. There's some concern about new tariff policies potentially hitting ad spend, especially from, say, Chinese advertisers who've been big players.
Ah, geopolitical stuff impacting ad budgets.
Could happen. And, advertising is always sensitive to the broader economy. If things slow down, ad budgets are often one of the first things to get trimmed.
But isn't there an argument that in tough times, advertisers focus more on platforms where they can track results, like TTD?
That's the potential silver lining, exactly. Performance-based platforms where you can really measure your return on ad spend might actually gain share during uncertain economic times. So it cuts both ways.
Okay, so pulling this all together, the trade desk seems to be at a really interesting, maybe critical point.
I'd say so, yeah. They're definitely facing headwinds. The Kokai transition needs to succeed. Competition is intensifying, no doubt about that.
But the core business seems strong.
The core business model, the client relationships, the position in growth areas like CTV and retail media, those are still significant strengths. That 95% retention rate speaks volumes.
And management seems aware of the issues. The reorganization, the share buyback.
Signs they're trying to address the execution stumbles and that they believe in the long-term value, yes. Expanding the share repurchase program suggests confidence.
So for an investor, it sounds like potential opportunity due to the lower valuation, but with very real risks attached, especially around Kokai's success.
That sums it up pretty well. The next few quarters are going to be crucial. Can they get Kokai firing on all cylinders? Can they execute well in CTV and retail? Can they fend off AppLovin? Those are the key questions. It's definitely not a slam dunk, but for long-term investors who believe in the open internet advertising model and TTD's position, the current price might be worth a closer look.
A lot to weigh up there. Thanks for walking us through all that complexity. So, to recap quickly, the stock took a hit, largely tied to the slower-than-hoped rollout of their new Kokai platform.
Right. But the underlying business helps major advertisers buy ads efficiently and transparently across the digital world, especially in growth areas like connected TV.
The Google Antitrust ruling offers potential long-term upside, but it's uncertain and won't be immediate. And competition, particularly from AppLovin, is definitely something to keep an eye on.
Exactly. It's a dynamic space, and TTD is navigating some significant challenges alongside its opportunities.
Absolutely. Well, hopefully this gives you all a much clearer picture of the trade desk right now.
Yeah.
As always, do your own homework before making any investment decisions.
Definitely dive deeper if you're interested.
Thanks for joining us on the Deep Dive. If you enjoyed this, please hit subscribe, give us a like, maybe activate those notifications. It really helps us out, and you won't miss our next exploration.